Most agency owners think selling their agency starts when a buyer shows up, but it doesn't. It starts years earlier with your financial infrastructure, because buyers are not just buying revenue, they're buying confidence. And today, we're breaking down 5 financial steps Karl Sakas talks about that can dramatically impact your agency valuation, and how the right CPA helps you get there. Hi, I'm Craig Cody. I'm a CPA and certified tax coach. At Craig Cody & Company, we work with marketing and PR agencies, helping them improve profitability, cash flow, and long-term enterprise value. And one thing Karl Sakas consistently talks about is preparing your agency before you ever go to market. Because when buyers look at your business, they're not just evaluating growth, they're evaluating financial maturity. So let's walk through 5 critical financial infrastructure areas that agency owners need to address before a sale. Step 1 is move beyond cash basis accounting. One of the biggest red flags buyers see is an agency still running entirely on cash basis accounting. Now, cash basis may work for taxes, but it does not always tell the full operational story of your business. Karl talks about the importance of understanding how revenue aligns with delivery, and buyers care deeply about that. They want to know when revenue was actually earned, whether projects are profitable, how labor aligns with client billing, and what future obligations still exist. Cash basis accounting can distort all of that. For example, you might collect a large retainer upfront in December, and on cash basis, revenue spikes, but the work may not even be delivered until January, February, or March. And that creates noise in your financials, and buyers hate noise. Accrual accounting gives a clearer picture of operational performance. It helps buyers understand real margins, revenue trends, profit consistency, delivery efficiency. And honestly, it also helps you run the agency better. We've talked previously on the Progressive Agency podcast about the importance of understanding real financial metrics and making decisions based on accurate reporting. The right CPA should help transition your agency into a cleaner, accrual-based reporting long before diligence begins. Because trying to rebuild financials during a sale is a painful process, it's expensive, and it's stressful. Another item is bring in a controller or a fractional CFO. Karl also emphasizes financial leadership, and this is where many agencies will fall short. A bookkeeper records transactions, a controller or fractional CFO interprets the business, and there's a huge difference. If your financial process still looks like do-it-yourself spreadsheets, or I check the bank account every morning, or my bookkeeper handles it, you're probably not ready for a sophisticated buyer. Because during due diligence, buyers will ask questions like, why did margins shift last year? Why is utilization declining? Why did payroll spike? Why are receivables aging? And somebody needs to answer those questions clearly and confidently. Not emotionally, not defensively, but professionally. A good controller or fractional CFO helps you clean up reporting, improve your forecasting, build better financial consistency, prepare for due diligence, and create credibility with buyers. And credibility matters because buyers are evaluating risk the entire time. The more confidence your financial team creates, the more valuable your agency becomes. Quick question. If a buyer asked you today for your last 12 months of financial reporting, would you feel confident sending it over? Or would you need a few weeks to clean things up? Drop a comment, let us know. I read them all. Another thing that Karl will talk about is getting a formal valuation before you need one. And that's a smart move. Get a valuation before you go to market, even if it's a basic one. And why? Because most agency owners dramatically overestimate or underestimate their value. And neither one is good. A valuation gives you a reality check, a benchmark, a strategic planning tool, a defensible starting point. And without one, agency owners often walk into conversations emotionally attached to a number that buyers simply won't support. And that creates friction right away. And here's the bigger issue. Valuation is not just about revenue. Buyers care about the quality of your EBITDA, your client concentration, your recurring revenue, your team structure, operational maturity, financial consistency. And you may think, we did $4 million last year, so we should be worth X. But that's not how buyers think. And it's much better to learn that privately now than after receiving a letter of intent that's 30% lower than you expected. The right CPA should work alongside valuation professionals items to help position your agency properly long before a transaction starts. Building your add backs. This is a list of things on a P&L that we add back to come to what we call an adjusted EBITDA. And this is one area agency owners constantly underestimate. Karl talks about preparing for EBITDA recasting early, and he's absolutely right. Buyers almost always adjust your EBITDA during diligence. They look for one-time expenses, non-recurring costs, unusual legal fees, consulting projects, temporary payroll spikes, owner-specific spending, extraordinary write-offs. And these are called add backs, and if you wait until diligence to build that list, you'll forget some things, or worse, you'll look disorganized. Start tracking these items now, every month, every quarter, document them clearly, because clean add back schedules can significantly improve your perceived profitability. And more importantly, they improve buyer confidence. A CPA experienced with agency acquisitions should help organize and support those adjustments proactively, not after the buyer starts asking questions. Be ready to explain financial hookups. Every agency goes through a rough spot. Revenue dips, margins compress, there's a bad quarter, there's a client loss or multiple client losses, and buyers understand that. What they don't like is uncertainty. Karl talks about the importance of the narrative, and that matters financially too. If your revenue dropped last year, explain why. If margins shifted, explain why. If you took a large write-off, once again, tell the story. Buyers expect transparency, and what destroys trust is vague answers, defensive explanations, inconsistent reporting, and contradictory numbers. A sophisticated buyer will eventually uncover everything anyway. So your goal is not perfection, your goal is clarity. The agencies that command strong evaluations are usually the ones that can run confidently and explain their numbers, not just produce them. So here's the big lesson from Karl Sakas' approach to agency financial infrastructure. Strong valuation comes from strong financial preparation, not just growth. The agencies that attract better buyers and better deals usually have accrual-based reporting, financial leadership, updated valuations, organized add-backs, clear explanation behind the numbers. And none of this should start 6 months before a sale. It should start years earlier. If you're building an agency with long-term value in mind, and you want help strengthening your financial infrastructure, improving cash flow, or preparing for eventual succession or sale, go to craigcodyandcompany.com and schedule a consultation. We help marketing and PR agencies build stronger financial systems that support profitability, scalability, and enterprise value. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.